Good morning. Let's have a little chat about something from the world of finance called a ratio call spread. Now, I know what you might be thinking. Those words sound awfully complicated, don't they? It sounds like something you'd hear being shouted across a busy trading floor in the city, but I promise you it's not as scary as it sounds. We're going to break it down together, piece by piece, just like we do with the morning's headlines. Think of it as learning a new recipe. At first, the instructions might seem a bit daunting, but once you understand the ingredients and the steps, you'll see it's quite straightforward. We'll take it slow, use simple language, and by the end of our chat, you'll have a much clearer picture of what this strategy is all about. We'll be using a company we all know, Microsoft, to make things feel more familiar. Imagine you have a view on where Microsoft's shares might be heading in the next month or so. All right, let's get to the heart of it. What exactly is this ratio call spread we keep mentioning? In the simplest terms, it's a strategy where you are dealing with two different types of call options. Now, a call option gives the owner the right, but not the obligation, to buy a share at a set price by a certain date. Think of it like putting a deposit down on a new sofa. You pay a small fee to lock in the price today, giving you the option to buy it later. With our strategy, we are both buying one of these call options and, at the same time, selling more than one call option at a higher price. It's this imbalance, this ratio, that gives the strategy its name. Firstly, this is a strategy for when you are feeling gently optimistic about a share. The technical term for this is mildly bullish. The ratio call spread often performs best when this implied volatility is high. Why? Because when volatility is high, the price of options is also high. Now for the most important part of our chat. With any financial decision, we absolutely must have a clear-eyed look at what we could gain and, crucially, what we could lose. With the ratio call spread, the potential profit is limited or capped. This might sound like a bad thing, but it's the price you pay for setting up the trade so cheaply. Your maximum profit happens if the share price lands exactly on the strike price of the two options you sold. Right at the moment they expire, it's a very specific target. The profit comes from two places. Firstly, the call option you bought has increased in value because the share price went up. Secondly, the two options you sold expire worthless. Now, we must turn to the other side of the coin, the risk. This is incredibly important. With a ratio call spread, the potential risk is, in theory, unlimited. This is the feature that makes this strategy one that requires great care and attention. The risk comes from that extra call option you sold. Remember, you bought one, but sold two. This leaves you with one uncovered or naked call option. If the share price were to rise dramatically, far beyond what you expected, your losses could keep growing and growing as the price climbs higher. Right, let's make this real. Enough with the theory. We're going to use a company we all know and see on our computer screens every day, Microsoft, which trades on the stock market under the ticker MSFT. Let's imagine that today is the 12th of August, 2025. We've been watching Microsoft's shares and we have a particular view about what they might do over the next month or so. Let's say Microsoft shares are currently trading at £400 each. After doing our homework, we've decided that we think the price could drift up towards £410 over the next month, but we really don't see it going much higher than that. That specific view is the perfect trigger for considering a ratio call spread. It matches the profile of the strategy perfectly, a belief in a limited, modest increase in the share's price. Now we need to look at the options that are available for Microsoft. Since our view is for the next month, we'll look at options that expire in about 34 days, on the 15th of September, 2025. Based on our view, we might decide to buy a call option with a £405 strike price and sell two call options with a £410 strike price. Let's get down to the brass tacks and actually put this trade on. We need to see what these options will cost. The September £405 call option costs £4 per share, so £400 total. The two £410 calls bring in £2 each, so £400 received. So let's look at our bank balance for this trade. We spent £400 on the call option we bought. We received £400 for the two call options we sold. The net result is that it cost us nothing to enter this position. The trade is now officially on. Let's start with the best possible outcome. On the expiry date, the share price closes at exactly £410. This is the sweet spot. The two £410 calls expire worthless, so we keep the £400. The £405 call is worth £500. Our total profit is £500. What if Microsoft's price only goes up a little bit, closing at £407? We still make a profit, just not the maximum amount. Our overall profit would be £200. Not as good as the maximum, but still a positive result from a trade that cost us nothing to enter. Now for the dangerous scenario. What if Microsoft's share price soars to £420? The two £410 calls we sold are now a big problem. We would lose £10 per share on 200 shares. That's £2,000. Our one call makes £1,500 profit, but our net result is a £500 loss. You don't always have to wait until the expiry date to finish your trade. Just as you can get into the position, you can also get out of it early. This is called closing the position. Let's imagine it's a week before expiry and Microsoft has moved to £409. We might decide to close early and take a £250 profit. Most importantly, closing the trade is your main defense against unlimited risk. If Microsoft starts climbing past 410 and hits 412, your alarm bells should be ringing. You can limit the damage by closing the position immediately. A small, controlled loss is infinitely better than a potentially huge, unlimited one. So there we have it. We've taken a gentle stroll through the world of the ratio call spread. It's a clever little strategy for a very specific point of view. It is for the cautious optimist, the person who predicts a small and steady rise in a share's price. It's a tool for nuance, for expressing a more detailed opinion than simply up or down. The ratio call spread involves buying one call option and selling two at a higher strike price. It's designed for a mildly bullish outlook and works best when option prices are high. Remember, the potential profit is capped, but the potential risk is uncapped. This is not a set-it-and-forget-it strategy. It needs to be watched carefully. Finally, remember that managing the trade is just as important as setting it up. You can and should have a plan to exit the trade before expiry, either to lock in profits or cut losses. I hope this has been a helpful and clear introduction. It's always fascinating to learn a little bit more about the different ways the world of finance works. Thank you for joining me and see you next time.